What's going on, guys? Welcome into another episode of Money Moves. The market is ripping new all-time highs. We've got inflation expectations and bond yields are on the rise, screaming a little trouble at the same levels that historically triggered presidential intervention, yet we see the stock market hitting those ATHs, as Mr. Breedwell absolutely loves. We're witnessing a macro divergence, one that's putting pressure on housing through rising foreclosures, even as new buyers are slowly coming into the market. We've got AI updates. We've got a lot of stuff you're going to give your thoughts and predictions on. Even though we don't see any Fed rate cuts likely, you're very convinced that it's going to happen this year. We're going to get your thoughts on that. We've got earnings, a lot of good stuff coming up in today's show. Stay tuned. All right, Mr. Breedwell, welcome back.
Howdy.
And
you know, it's a
you look happy.
it's
right
a
now.
welcome back. I am.
You look like
am
like you're just in your bag right now. Like,
I mean,
everything you've been talking about is coming to fruition.
I feel like a Christmas present in Santa Claus shop on the 24th because I'm always in my bag. I'm very happy with market movement. Sentiment's good.
Yeah, we got some good stuff to unpack today.
Well, lots of good stuff. Lots of I told you so moments. And I hope everybody I told you so that they listened.
Yeah, I mean, well, I followed your lead, and let's just say I'm happy with where my portfolio is at right now. So
on both sides on that other thing too. I'm glad you closed that one position out we were talking about.
Yes.
Now you would have gotten semi-screwed through like Saturday. You would have been kind of bucked.
Oh yeah.
You'd have been super.
Markets.
I think what's a crypto 81, 82?
Yeah, it's pumping. Bitcoin is, I think, around 81.5 right now, something like that. So I mean, along with the market, we've seen some really nice rallies from the lows on Bitcoin and just the crypto market in general. Obviously, we've seen
crypto lagged, which is not normal. I'll point that out. I had been using, maybe so for a particular reason, but a lot of advisors and hedge funds and serious firms use crypto as a temp checker, appetite sizer. What's the risk appetite in the market?
Mm-hmm.
And I would say this would be the first relief rally that we've ever seen. And we're out of a relief rally because we're back to all-time highs. We're back just in the bull market like that started last April.
It's full-on bull market, right?
Yeah. But this was the first time we did not see as much participation from the crypto side as we had seen in 2020, in 2023 to 24, in 25.
Mm-hmm.
You know what I mean? We've had this like winter in crypto. It's starting to expose that what we were talking about, how leverage was an issue in the stock market. I think it's also a huge issue, and I think we now can prove
probably bigger in crypto.
Because why would crypto be going through that when stocks are not? Well, because people are
overly leveraged,
borrowing money to buy crypto.
Yeah.
So and when rates are too high and the market's choppy, people are getting liquidated. So I think that is now where we can say, if interest rates are higher or trending up, and the market's volatile, there might be opportunity in equities in certain areas. Energy did really well. Healthcare has done very well. AI has continued to do well, although being choppy. We're seeing certain tech names do well. But You're not really seeing that in the crypto space. So maybe that's now a correlation we can make. And everybody's learning here. We are as professionals, everybody is as retail investors too, because crypto is a new space. But maybe now that's something we need to take into consideration moving forward, where it acts like this, like a stock, and it acts like this, like real estate.
Mm-hmm.
It's rate sensitive.
Yeah, big time. I mean, really looking back in hindsight, it was the beginning of the Operation Epic Fury, what was like March 29th or something, was really kind of when we saw the big pullback in stocks and crypto. And the last 2.5, two-ish months, we've been seeing, or month and a half, I guess, right? Been seeing like a really nice rally right now. That took us right into earnings season.
Yep.
And overall, what would you kind of rank and score earnings based on what expectations were, where they came in at, and how the market's kind of absorbing all of that news? And well, I'll give you the follow-up question after that.
I would say we're at a A, not plus, not minus, just a,
Which is
90, was that 5, 4? Whatever's not a minus and whatever's not a plus.
Yeah,
just an A. There's definitely room for improvement. There's areas of the market that are still like lagging. Like financials have been, I've been expecting financials to recover better than they had for a while. That's an area of concern that could get better. Healthcare, not as good. I mean, the problem is it was so hot in COVID and right post-COVID, which really was like 2020, 2021. And then we just had a shitty president. Healthcare has been a dog since then.
Yeah.
There hasn't been like much in healthcare. It's been AI. And what's crazy is how AI can really, I mean, you've seen the test where they put this through like research papers, and it teaches the AI just one thing to look for, and then it puts it through patient databases like, hey, I can identify this as probably somebody that might be at high risk for this. I don't know how that's not made its way into a healthcare vein yet, but that's where I see AI. AI is going to put its fingers in everybody's pie a bit and should enhance it. And I just don't know how that hasn't made it over there yet, because we're seeing it in the financial systems or people talking about it. I think we're at the tail end of this crypto bear market. And I think what you're going to see is 2026 being kind of the year of adoption. I mean, we will get the Genius Act passed probably later this year or early 2027.
Crypto?
The
Clarity Act?
Clarity, excuse me. Genius, this one already passed.
Yeah.
Clarity.
Yeah.
Sorry, y'all.
Yep. They're saying they're trying to push it for by end of summer, best case end of July.
It could, but I wouldn't be upset if, I wouldn't be shocked if it bled into early 27. And that is when we should fully recover in most, again,
that's where
all speculation
on the sidelines is going to come.
Yeah.
But it's kind of where the two
we'll see it
together, right?
You'll see institutions actually putting their money in it, not holding your money in it. Follow what I'm saying there?
Yeah.
You're not going to see them say, oh, we're going to launch XYZ trust or mutual fund or ETF or what have you. We're actually going to buy it, and we are holding it like we're holding it. It's not for you, it's ours. MicroStrategy. Think that. Think, who am I thinking of? Tom Lee. Bitminer for Ethereum.
Yep.
These are this, but now think of the top 100 companies and their appetite for whatever it is. I'm not saying it's going to be Bitcoin. I'm not saying it's going to be Ethereum. I'm not saying it's going to be Solana. I'm not saying it's going to be, I'm not saying it's going to be any of those because I don't know.
Yeah.
But it's probably going to be one of them, all of them, a combo.
Risk on appetite will increase significantly for crypto. Like you said, though, I mean, there's you got your top, call it 20 to 50 that could be considered recognizable, at least your top 10.
Mm-hmm.
They're going to get more attention than they're already getting right now. So we're going to see market cap expand in the crypto space pretty significantly with the amount of dry powder and the merging of kind of the financial rails and infrastructure and regulation that Wall Street has been waiting on, right?
Yep. That's
that's
what I would expect.
And I know you've got some exposure into crypto. I've got some exposure into crypto.
Not a lot.
What do you think
But I got some.
that will do? Or maybe what are you shifting? And let's just take clients aside. Don't even say what you're thinking about for your clients. How does that change your perspective on exposure for your own portfolio in crypto? Does it go from 1% to 5 to maybe 10? Like, how are you approaching that? And what are you looking for when that does happen as a little bit more of a nudge to feel comfortable playing in some of those spaces?
Well, I think the nice thing about if and when that level of adoption comes, whatever the asset class may be, you're going to be able to get proxy exposure at some level via the companies that, you'll own some of the largest companies and they would likely own some sort of investment in that. It's more common to be diversified with your income stream versus just having a single income stream like was usual in the olden days. So I think that's going to happen by proxy. But yeah, we could start. I don't think I don't see us. Well, they would have to put it in a way where we could buy it. Right now, I can't. There's like no way for me to like via Schwab for clients buy Bitcoin.
I think Schwab, didn't they just release something that they're planning on doing that though?
Yeah, but right now it's all fund based, and if it isn't, it's gonna have a massive commission link to it.
Yeah, I believe
so.
I'm looking it up right now.
Yeah, so to me,
yes, Charles Schwab allows you to gain exposure to Bitcoin, but with limitations. As of April 2026, Schwab is rolling out Schwab Crypto, which will offer direct spot Bitcoin and Ethereum trading.
See, spot.
Yeah, so go ahead and clarify what that is for people. Currently, you can invest in Bitcoin through approved.
It's the equivalent of buying like
futures.
gold in the spot market, right? It's like it's still a little bit different. It's similar, but it's a little bit different. It's like commodities trading.
Yeah, I was gonna say
More commodities like versus stock.
So they're rolling out direct crypto trading. You can buy approved spot Bitcoin ETFs.
ETF,
such as the iShares Bitcoin Trust.
See, it's not like
that. So
Bitcoin.
it's not. Yeah, right.
So that's the idea because there's no way for them to deliver it right now, like into your account and then sell it out of your account. Like they just don't have the infrastructure set up, per my understanding. So that day will come. Will it be? We would have to treat it like an individual name. And when we speculate, because that's what you do with Bitcoin, at least how we currently treat it, or Ethereum or whatever crypto it is, you're speculating at least right now. Probably maybe 1 or 2%. I mean, you don't put 5 to 10%. You do that with your core holdings. Stuff's been around for a while. Apple's, Microsoft's,
well, especially
things
the
like
volatility that we've seen in those.
Yeah,
and those points, right? I mean, it's just
straight on the upswing.
What did you say? Ulysses came in here and he was asking like, "Hey, should I just buy and hold and not, what did the rotisserie chicken?
Oh yeah,
figure like set it,
set it and forget it, man.
But there are certain things that you don't set and forget, right?
Mm-mm.
Like, can you distinguish those two things of like really individual stock picking versus like the tried and true stuff? Like, how do you?
Yeah, I mean, it's how I like to manage a lot of my clients. It just makes sense, though. It's easy. You got to break things down for people.
Yeah, that was actually very relatable.
When we buy ETFs, there's a lot, like, especially when you're doing a broad market, equity focused ETF. And I was talking about specifically one with Yuli that focuses on the quality, the highest quality companies in the S&P 500 and allocates the majority of its capital to those companies. You don't really need to do much with that. You can buy that thing and just keep putting money in it. They got you. They already got it diversified. It's spread out. It's not like a sector focused ETF. You're buying the top 100 companies in the S&P 500. It's really not that complicated. They tell you how they determine that with a formula. They apply that formula. It happens for you. They charge you a small expense ratio. Bing, bam, boom. So that's something where you don't really have to think much. It's like, boom, that's done for me. I don't got to be the smartest guy in the room. I just got to put my money there. Then if you want to go pick stocks as a retail investor, which I don't advise, I already mess up enough as a professional investor.
Yeah, I was like, you got to be a full-time, all day, every day, like living, eating, sleeping, breathing it to feel like you have the confidence to do that better than the big quants and institutions. And
there's a lot of stuff. There's just so many stocks, you can't know everything about every single one. And so it's easier to just buy funds as retail investors. And then you say, okay, I know AI is hot. I want to be in AI. You can just stop there and then go buy an AI focused ETF. They do the research they do the hard, heavy lifting. And then you just know the factor or focus you're going for. That's a smart idea and that's a smart way to invest. That's how I do for a lot of my clients. We just custom build. Stocks are just a lot harder. That's why they are on big upswings, typically more rewarding than a broadly diversified ETF is. And they also hurt a lot more when you lose in them. And so you see like Intel, for example, today up 12, 13, 14% in a day. That's a really good year for a lot of equity focused ETFs. And that can happen. And that sure could happen in an ETF. Probably not going to happen in an ETF, not a non-leveraged one. So to me, when you have them both, where you kind of build your foundation, where you're like, hey, I got the solid foundation of a really good financial plan with a portfolio, and we still rotate them. We'll buy more of this type of ETF and sell. So we rotate through factors. That's factor investing, and that's typically what I do with my clients. And then I go overweight in individual names. Like we buy individual stocks. Hey, I think this is a good stock to own. Hey, I think this is a good stock to own. And we're not batting 1,000% on that, but we were batting well over 700 or 800. And that will uplift the portfolio and get you better rates of return over a long period of time than just having everything in the funds. And then when the market goes through volatility, the ETFs help buffer out the downside versus just writing it all the way down in the individual stocks. That's how I do it for a lot of people. For myself, I do 100% stock, minus a little bit in my 401k. I have some ETFs. I know Matt has primarily a 100% individual stock. You have to have a bigger risk appetite for that. Yep. But it comes with a big reward. And for people like Matt who are, very experienced, have the, wherewithal to understand what's going on, myself, other professional investors or semi-professional investors or people with the risk tolerance, that's a good idea. The whole point being, it's really hard to pick individual names. That's why in California we have, think about Keno at the casino. How hard is it to pick? That's why they run it every hour. I mean, you ain't gonna win it. Look at the horse races. It's hard to pick. It's easier to say, I know a horse is going to win than I know the horse that's going to win.
Yeah.
So when you buy a fund, it's almost like buying the horse race. Is there going to be a winner of the horse race fund? Yes. I know there's going to be a winner. I just don't want to focus on picking the winner. I just know there is going to be one. I'd rather play that game. You give up a little bit on the upside, but you still make plenty of money. For retail investors, I don't think they should do.
No, dude, I'll be honest. I mean, any of the individual stocks that I've invested in pre-IPO, I'm like, Ryan, what do you think of this? I've got a couple other trusted people where I'm like, what do you I'm not the expert, right? I lean on you and the experts that I know are studying this and eating, breathing, and sleeping this stuff all day long. And you usually come to me and go, hey, I got a real estate, question. What do you like? So it's having that trusted counsel around you that kind of gives you the confidence to do those things. Talk to me about, just kind of give some macroeconomic data. PCE break-evens and the 10-year Treasury are somewhat all inflated right now. And we saw core PCE, which is obviously the Fed's preferred inflation gauge, jump a little bit to 3.2 year over year in March, which was the highest since November of 2023. We saw PCE jump to 3.5, which is the biggest single month move since mid-2022. We saw the 10-year break-even inflation rate hit 2.47, and we saw kind of bond markets uptick a little bit. The 10-year Treasury yield climbed back to 4.42 to 4.45, getting to that 4.5 level. So from that, with the 10-year yield back above 4.4, core PCE just hit that 3.2. Question for you is, from a stock market and a bond market perspective, is the bond market like finally forcing a reckoning that people are going to have to pay attention to? Or is Wall Street right to just kind of like, that's noise, shrug it off, like, let's keep rocking. We got more room in this, this venue to keep partying.
Yeah, I mean, interest rates are just high because the Fed rate's high.
Yeah.
The real inflation's sitting like 1.92, somewhere there, 1.92 or 2.04. I know it sounds crazy, but go look up real inflation. It's a metric it takes out all the stuff that does
inflation, right?
Yeah, it takes a lot of the equations are like this is really not felt by everyday human beings. The trueflation number is at 2 or sub 2%. And the other thing I would say is if all this stuff was happening, if, the interest rates were as affecting to consumers as they are stated, then we wouldn't see the market doing what it's doing. It's just making it so people can't buy as many cars as they used to, can't buy as many houses as they used to. But people are more okay with that now because they buy. There's more retail traders in the stock market, so they use the stock market more frequently, and that helps. With that being said, the stock market likes low interest rates too because there's people that lend to buy stocks. Not as much as it's almost the opposite for real estate. Like cash buyers are as rare as people that are lending to buy stock in the stock market, and they rely on opposite things. The stock market relies on just cash, and the real estate market relies on cash to a degree, but so you can get leverage.
Hey, what's up, guys? I'm so excited to announce if you are an investor looking to generate consistent passive income, then I've got something for you. I just launched the Imagos Income Fund. It is a private investment debt fund. So instead of relying on long-term appreciation or big exit events like most real estate syndications do, we decided to keep it simple, focused on first position asset-backed lending just like a bank, meaning your investment is backed by real collateral and structured to produce income from day one. The target return, 10% paid out annually and also paid out monthly. So no guesswork, real passive returns, true mailbox money. And because we're in the debt position, not equity, we're able to prioritize downside protection, maintain shorter durations, and stay in control of the risk, which is most important in environments like this. This is built for investors who want steady cash flow, strong capital preservation, and real asset exposure without the headaches of owning, managing, and waiting years for a payoff. So if this resonates with you, if you want to learn more, I put together a full investor presentation breaking everything down. All you got to do is just text the word income to 844-447-1555. That's income to 844-447-1555. I'll send you everything so you can see if it's a fit for your portfolio.
So until the cost of capital comes down, the stock market is the easiest way to make returns, and so that's why a lot of money is going there. It's just easier to do right now. To me, the rates on the 10-year are just indicative that it's going to cost more for capital right now, but not an indicator that there's something negative coming in the market.
Yeah. I mean, you and I were talking. I mean, I think it's way more important for real estate than it is for the stock market.
Yeah. Although, I mean, number one, maybe stocks are in second or third for like level of importance, but cash flow is important for both of them. Just you need a lot more cash to leverage into real estate versus saying, hey, I'm just going to put $100 a month into the S&P 500. The barrier to entry is so much lower, is my point. You can't put $100 a month into a house and live in it if it's made out of anything but cardboard, right?
Yeah.
So just that's where cost of capital, when it comes down, You will see a lot of it go into, I think, single family and then the stock market.
So is the divergence between bonds and equities sustainable in your opinion?
Yeah, they're supposed to be.
Okay.
Yeah, they're supposed to be inverse instruments. Bonds, for example, rallied very hard in 2008 during the rate cut beginning and cycle. You could almost made about 14% rate of return in bonds in 2008 through 2009. Inversely, you would have lost about 50% in the S&P 500. So that's a complete opposite movement. They were completely correlated from 2022 to 2023. Stocks and bonds both shit the bed.
Mm-hmm.
Why? Interest rates went up and we had volatility in the stock market. We finally had to pay for all the free money we had during COVID.
Yeah.
So inflation. So really no. They're just in a cycle where we have elevated stock prices and bond yields are high, but they were down about 0.5% today. But bond yields are staying higher than they should be because if the stock market's going up, that's what's been happening. Well, yeah, that was what happening when we've been in a zero interest rate environment. We're not there anymore. So where people are going to start noticing yields higher than they have been in the past couple decades, but noticing the effect being similar as when they were lower. Oh, okay, I guess money's not going to cost 1, 2, 2.5%, 3% anymore. It's going to cost 3.5%, 4%, 4.5%, and everybody's going to be fine and make money. We're still in the process of people digesting that we are not going to 0% interest rates. We've almost been there.
Oh, shucks.
We're like 17 years, 16 years in it. That's a long time.
Yeah.
So it's going to take a couple years for being out of it for people to finally say, okay, well, I'm swallowing that pill. That's really what it is to me. People are just getting used to the cost of capital. Rates will go down, no doubt. But I mean, the 3-year is going to be hovering between 3.5 and 3.9, probably in a healthy market, and should be. And people should be happy to pay that because you can make 20 fucking percent in the stock market and 9 or 10% on your real estate. I mean, what are we trying to do here?
Yeah.
If you're not happy with that, go to the casino.
Did you see that recent clip of Buffett talking about the appetite for, gambling in today's world and, one day option?
Yeah, you did say it's like there's a little bit more of a casino than there had been.
Yeah.
But
in tech, obviously.
the other thing I like that he said is like, I'm not keeping up on modern shit. I just don't do that.
Oh, he even said too, he's like,
I don't even track it.
This stock market, I understand this stock market less.
Yeah.
Now,
Finally.
it's just not the same,
Finally, it's been said by somebody who knows what they're doing.
Yeah, he was just like, it's
the
just
market
different.
Today is different than it has been.
Yeah.
That's why people like myself can be successful and why like you see older people, like they're not always unsuccessful, but they move in a way.
Historically, what worked is not the same, right? Like when I say to people in real estate, I'm like, hey, look, the last 3 real estate cycles you were a part of, like you got to meet this market where it's at right now. Like what the landscape, policy, infrastructure, demand, all of it, technology, it's different. So you can't treat it all the same. And I think, when people say like, well, historically you got to go back, and it's like, I get that. But I think the weight that people could get away with putting on those old historical, things they were pointing at, that created validity and maybe strategy and conviction in what they were going to do next. I think that weighted percentage has significantly dropped in the world that we live in today.
I agree because the access to information is so much higher. It's like, I don't know, so I'm going to, for like in my world, hey, a bear market lasts an average of 3 years. No. I mean, we had a really bad rolling recession, and that was 1.5 years in under the Biden administration. That's a recession, like a real recession. That should have lasted like typically, they would have said like that's going to be like 6 to 8 years in a typical scenario. That just doesn't happen anymore. That's why I'm telling people when these pullbacks happen, and I don't think we've even seen a super serious one yet. Last year's was definitely worse than this year's. I mean, take that as an opportunity if you have discretionary income to buy stuff at the same price as you were already buying stuff, just at that price again.
Mm-hmm.
It's like a sale.
Yeah.
And you may not get it at the very bottom. That's okay. That's okay. You were just about to buy it for a higher price. So just keep buying it.
Yeah.
It's man, that infomercial is so fucking. Set it and forget it.
I didn't know we were talking about. Ryan pulled up an old. He's like, those old rotisserie chickens? Like my mom used to throw down, and that rotisserie chicken.
We had the big white one. Yeah,
and I was like, yeah, but their commercial, and the infomercial was like bunch of old ladies basically putting the
and one white guy.
Yeah, and putting
set it and forget it.
The rotisserie chicken in there and going, set it and forget it. Set it and forget it. And Ulysses was in the office before we were starting the show, and he was like, what should I do with my investing strategy, and trying to get all cute with it? And Ryan's like, let me show you something real quick. And pulled it up. So that's what we were referring to earlier. All right, so let's shift over to Fed rate cuts.
Yeah.
And we've got Kevin Warsh, Jerome Powell going out in 10 days. We've got Warsh taking over the Fed on May 15th. Does this inflation data make his job harder or easier coming in the door? And how does Wall Street actually feel about the transition right now? We had the first, call it 8-4 descent amongst the Fed governors since 1992. So obviously there's some differing opinions around rate cuts and inflation and how sticky or impactful it really is. And then obviously we know that anytime a new Fed chair comes in, there's still some uncertainty around how they're going to operate and if they're going to retool some stuff. So what are your thoughts on Kevin Warsh? How does that tie in with Fed cuts? And what in the, call it short term, does that do for the markets as they kind of absorb him coming into that seat?
So I think he was a solid pick. I think he's going to grow on people over time, similar to the Treasury Secretary. Is it Bessent?
Yeah.
Scotty boy.
Scotty.
We love him. Love you, Scotty. I would expect there to be some volatility this month, which I'm surprised we haven't seen more of. Sell in May and go away.
Yeah, that was the first time I've heard that.
Yeah, it May has historically been more volatile than not volatile.
And why is that?
I don't know.
Literally no reason. And just going into summer, and
Fed chair timing is always around this time. There's little things that tend to correlate
for time.
Psychological. Nothing really of substance.
Okay.
But typically when we get a new Fed chair, we'll get a little a cup and handle, but like a dipping cup and handle. So we'll get a little dip and then a nice up. So that's what I would expect there to be. There's going to be when he comes in, he'll start having some speeches, and people will start dissecting those and making some transit. And when people move money around, they'll have to sell this one thing and buy this other thing, and that's going to move the market a bit. So I wouldn't be surprised if there's a little bit of some choppiness. We revisited some numbers that we've seen before in the S&P, in the NASDAQ, in the Dow.
Yeah.
That shouldn't discourage investors for what I would hope and consider a potential nice setup. Because if he does, I don't think we're going to get much as far as weight goes until the June meeting, which I do think is going to be a pause.
That'll be his first meeting.
But I think what he'll say at that June meeting is, or he will indicate, that rate cuts are definitely on the table and are looking appropriate. And when that happens, the market will price that in, because that is not priced in at all right now. I mean, yes, it is for me, but it's not in the market.
No rate cuts are priced in now, right?
Well, here's what I was going to say. We're at, I'm not kidding you, 0%.
For July.
Yeah, for months, it's been at 0%. The highest percentage likelihood in the next 12 months for a rate cut is in July. It's sitting at about 11% chance. Yeah.
Okay.
But that's still, as I will bend the knee, that's still the future. Again, I'm not going to be a hypocrite. The futures are not always indicative of what's going to happen.
Right.
I'm living and dying by that at the same time.
Yeah.
Right? I still think July is going to happen in the face of a 0, in the face of a 10. If it said 99, I'd be saying
sticking to your guns on that.
I'm pretty sure July is going to happen because I just know there's a lot of conversations happening behind closed doors we are not privy to. I know Trump picked this gentleman for a reason, and I'm very certain he's going to show up. And I'm
just thinking of what I said before the show, because Ryan and I were talking about this, and I was like, well, I mean, Ryan has always stuck to his guns on everything, and most of the time he's damn spot on. And I was going, I hope that we get that rate cut in July. I want that rate cut in July. I got fingers crossed for that rate cut in July. And I don't think it's going to happen. And the reason being is, obviously Trump picked him for a reason. So to Ryan's point, him putting somebody in there after, too late Jerome Powell and going in hard on the narrative of cut rates, that's setting the precedent and the temperature that he expects whoever he puts up for nomination to come in. He also, in his Senate hearing, was a little bit more hawkish, saying he's going to keep, the Fed and politics separate, which I think is obviously important, right? You don't want Fed policy being set by, president or administrations. They got to remain independent. But he was a little bit more hawkish. Some of his history as a Fed governor chair was a little bit more hawkish. But then you said he's the white hawk.
He's the white hawk,
he's gonna be the white hawk. Underneath, there's gonna be a little dove in there that might come in with a little bit softer policy that could hopefully lead to that. So your take is you're still sticking to that July rate cut. I'm going to hope for that July rate cut. I don't think it's going to happen. I still think there's some variables in kind of the macro that most of the Fed is going to want to see come through the system and have a little bit more data to feel comfortable making that. But I think all the signs support we could use a rate cut in a lot of areas and a lot of sectors.
Cost of capital is too high.
It is. But the strength of the economy, the strength of the stock market, the strength of a lot of these assets, these things are showing that we don't need that stimulus. Even though I want it.
I'll take a page out of their book. The stock market's not the economy.
Right.
So kiss my fucking ass. Cost of capital is too high. The stock market is at all-time highs. The economy is not.
So then
the economy is not any better than it was in 2019. It's just at a higher number.
Yeah.
It's a good market.
Yeah.
So why can interest rates be lower then and not now? I'm telling you, to me, it's somewhat political. I don't think Jerome Powell likes.
He doesn't. He does a good job of
He does, and I also don't dislike Jerome Powell. I just think he doesn't like him. I definitely think he's sticking around on the Fed board just to say fuck you to Trump. I give him respect for being gangster in that respect.
Yeah.
With that said, we shouldn't have cut rates to 0% in 2008, but we fucking did.
Yeah.
How can we justify, hey, we've never been here before, so let's do something we haven't done, but okay, we're never going to do that again. We've never been in a setup like this. Ever. Show me one time when the stock market's been at all-time highs and interest rates have been at all-time highs. Well, excuse me.
Not all.
Higher than they had been when, and I get we're saying we don't do things the same way, but if the stock market's so strong, put some fucking weight on it. Take something off of the real estate market because the real estate market is drowning, man. It's like throwing a Canadian tuxedo on a one-armed Michael Phelps. It's like what it is, dude. Homie's just spinning like a torpedo, but he's catching his air.
One-armed Michael. The shit you come up with. All right, well then let's talk about the real estate market because you're right.
Cost of capital's too high.
And this is where
you don't need a 1% cut or Just cut 2 quarter times. That's all we need.
Give people a little love.
That's all we need. Like, we need a 0.5% spread out. Just say, hey, we're going to cut in July and we're going to cut in November, in December.
Yep.
Give people some relief.
Well, and I think we're seeing the signs in the housing market as to why some of that relief is needed.
Oh, Michael Phelps.
That was good. Well done. Well done on that one. Where the fuck do you come?
I don't know. Sometimes it's pull them out of thin air.
So we do have foreclosures are rising. First-time buyers are the oldest ever on record, and new demand is flooding the market anyway. So what the hell is going on right now? People are struggling to kind of make light of what this, might mean for the housing market. So let me just give you a little backstory here. So U.S. foreclosure filings hit 118,727 this week, which is a rising trend as pandemic era protections expire and higher for longer rates.
What did you just say? They're still around?
Oh yeah, many of them were.
Oh my God!
Yeah,
got none of them in the stock market.
Yes, many of them were. A lot of those protections are expiring, and the median age of the first-time home buyers first-time home buyers has climbed to a record 40 years old, up from the late 20s and the 1980s, with first-timers now comprising just 21% of all purchases, which is an all-time low versus the historical 40% norm. We got mortgage applications, though, for home purchases are running 31% higher than a year ago, and National Association of Realtors forecasts a 14% increase in home sales for 2026, driven by equity-rich repeat buyers, primarily baby boomers, who are driving a lot of that, who are purchasing with cash or large equity stakes. So younger generations, somewhat priced out, earning power is not there. They don't own a ton of assets yet.
Yeah.
Baby boomers got equity in the homes, been investing in the stock market, things like that are giving them a little bit more purchasing power to keep some of the demand flushing through the housing market. So I think it's, interesting, the haves versus the have-nots dynamic in housing is something that I think is really becoming the narrative here of like, if you don't have to buy, people aren't buying because they have no incentive to buy.
Well, you want to know the one thing I will say is also helping incentivize people buying. You go, okay, I'm not going to buy, it's expensive. But then you go look at rent, and you're like, shit, it's not that much cheaper to rent. So I just had somebody today that actually, one of my clients was like, yeah, I went to looked to rent, it was $3,400 a month. And then I looked at my savings and my down payment, and it was $3,900 fully impounded. I'm like, yeah, so you said you want to own the asset for $400 more. Exactly.
Yeah.
Yeah. I'm like, fucking, my fucking tear out of my eye. Like, good job. Exactly. It's going to cost more to own something.
Yeah, I was going to say.
But that's completely pencils to make sense.
I think there's a couple variables in this too that maybe aren't necessarily shown up in the data. The social culture that younger generations live in is, the narrative was never own your home and start a family and have the white picket fence. Like the younger generation, maybe we were the last generation, like millennials.
Oh man,
but Gen Z and younger, like that was not the narrative for them.
Don't get me on the Gen Z.
And then we already know how you feel with the Gen Zs.
Oh God.
And so you have this overall programming and psychology around like that was never a building block of the American dream for younger generations. Then on top of that, they don't have the earning power. They have way more debt. They are, not wanting to make financial decisions that are going to lock them up in something. They like to be a little more nomadic and move around and
the fucking finance a burrito from Chipotle.
They're
idiots.
But exactly. So those things don't add up, right? And at the same time, I think with the technology advancements of how to quote unquote invest now, I just don't think owning your home is seen in the same light as an easily accessible and liquid asset and investment the way other things now are being portrayed and projected.
Yeah, but I think people get sold this like bill of goods, like a dream. It's almost like when you tell people, like in the insurance space, buy term insurance, invest the difference. Well, yeah, that absolutely works, but nobody invests the difference.
Yeah.
So like when everybody ever you like don't like.
Well, this goes back to your intelligence comment.
CPA I was talking to, today, and then I have a very robust CPA team, and my CPA team is like, look, you have to remember, most CPAs are taught to just defer taxes. They don't ever finish like, okay, I deferred these taxes. How much more in taxes now is that going to cause? And I'm running like this stuff for these people. I'm like, oh yeah, look, you're gonna pay 26% or you're gonna pay 18.5 if we do it this way and put money in a non-qualified. Well, yeah, they want to pay 18.5. And the CPA is like, they're gonna pay $6,000 more in taxes this year. Yeah, but they're gonna pay $3.5 million less over their lifetime. You dumbass. Like, so it's just when you don't finish, you have to finish the equation. Things sound a lot better on the front end, and sometimes they just aren't. For most, like what we're saying to people, hey, what was Yuli saying? I'm going to put $1,000 in this individual. I was like, well,
Yeah.
I mean, that's like, sounds good.
Yeah.
Why don't you just throw it in this? Why don't you just throw this in this ETF though, and just like not be the
That's
expert?
where I think you're spot on with that. I think the intention for a lot of people when they're making a decision is they want to do the right thing.
Correct.
They think they're doing the right thing for themselves, but they lack the education, call it the team or the consultation around them, and just having like the real skills and discipline to do it consistently, which is like the foundational building blocks of investing in anything. Stocks, real estate, you name it, right? It's have a good team around you, have a good plan, and just have the discipline to execute on that plan consistently over a long period of time. And that's part of, I think, the psychology too of this
rotisserie chicken.
The rotisserie chicken, baby. Is this quick hit dopamine society that we are integrated in it is somewhat of it's a very big drag, I think, on people's ability to really like execute in that capacity over time. And so I think that's just something to be aware of, right? Is just to stay very aware of, because who isn't susceptible of getting pulled into quick hit, results? Everybody wants that. If I can shorten this, and get here that much faster and not have to deal with this, and this, like that sounds great. But, every wealthy person I know did not get rich fast. They really did.
No.
They got wealthy slow.
It's crazy. They just look hella good because they got money, Jeff Bezos. Like, so you should see him before the money. You know what I mean? Like, to your point, like 20, 25 years, but people want that. They want all of that in overnight. And it creates a lot of opportunity that people like us take advantage of. We just try to let you guys know it's not that hard, but it's also not that quick or easy.
Yeah.
And somewhere in the middle is the right way to do it.
Well, we'd love to hear your guys' thoughts. And of course, any particular topics that you want covered, shoot us a text 844-447-1555. If you want to connect with Ryan and his amazing team, send the word X-ray to 844-447-1555. If you're a passive investor and you want to get in on the Imagos Income Fund, want to learn more about that, mailbox money, text the word income to 844-447-1555. As always, we appreciate you guys tuning in. We'll see you guys in next week's episode. Until then, keep investing in yourself and your wealth on your march to $1 million and beyond. Cheers.
Cheers, y'all.